One of the best indicators of the struggles in the housing market, I got back from Boston 6 weeks ago, and I got into my Uber, and it turned out my Uber driver was a real estate agent, right? Yeah. And so it's really everything. It's the inflation numbers, it's the economy that's going to be slowing, and it's also just the overall kind of wear and tear that it does on the consumer. If inflation, let's say, is at 4 or 5%, how do they print trillions of dollars with the risk of inflation jumping to 20 or 25%? I mean, we don't want to be Venezuela. We don't want to be some of these countries where you have this kind of crazy inflation. So the question is, how do we get out of the next recession? And that's the question. I don't have the answer for that. We might just have to pay the piper at this point.
I want to start straight into talking about the Federal Reserve and your bigger macro picture predictions for the coming year. Now, the Federal Reserve is slated to meet next week, a very important meeting, the last meeting of the year. They are expected or telegraphed to raise interest rates by 50 basis points, according to Jerome Powell's latest statements at the Brookings Institution a few weeks ago. Now, this is in line with what the stock markets are currently pricing. Remember, back then he made that announcement. We had a big spike and a big rally. What do you think they're going to do going forward then? I mean, we know they're telegraphed to raise 50 basis points. Should they not surprise the markets? That's on the table. What's after that?
Yeah, so you're right on that. 50 basis points is what the market's pricing in. I think that's a no-brainer for next week. My guess is that they'll go to 25 basis point hike after that. And again, I'm looking at the symmetry of what they did, right? When they started raising rates, they started with a 25, they went to 50, then they had 475 hikes, and now they're kind of coming down the mountain on the other side with a 50 and likely 25. And I think by the end of the first quarter of 2023, they're basically not hiking anymore. But the kicker is they're not going to be cutting rates either. And I think that's going to be the shock for the market.
No, it's interesting because if you look at the previous rate hike cycles going back to the last 20 years, each rate hike was not as dramatic as this current one that we have. But you're right, the rate stayed consistently high for usually around 6 to 8 months, I believe, was the average time frame of sustained rate hikes before the Fed lowers rates again. And so this time what Jerome Powell is saying is that he's made it very clear he's not going to stop until the job is done. He's also said very clearly that he doesn't want to loosen monetary policy too soon. He said that has been a mistake Federal Reserve has made in the past. So how long do you think the Fed can keep rates high even if they stop raising rates?
So I do think inflation will remain elevated, right?
Yeah.
And elevated to me means 3 to 4%, maybe 5%. So again, it's already coming down. We know it's coming down. Oil prices have come down quite a bit. That's helping bring inflation down. But the key is does it go back to 2 or under percent, which is what the Fed wants? And my answer is no. The wage inflation is going to be sticky. Always keep in mind that when people get paid double what they were making, it's not like that business can double the price of an orange the very next day, right? So it has to be passed through over the course of a series of, let's say, years. And so what it's going to happen is you're going to see prices incrementally move up year over year to compensate for the hike in wages that we've seen around the globe. And I think that's going to mean that inflation stays north of 3% for at least 2 years.
Okay, I want to talk about inflation in a bit more detail in just a bit, but going back to your point about 25 basis points on the table, does that mean that markets will take that well? Because 25 basis points is somewhat more dovish than what we've been seeing. Like I mentioned, they've raised rates by 6 times already, 0 to 4%, pretty dramatic in 1 year. 25% relatively, 25 basis points rather, relatively speaking, is quite dovish.
Yeah, so 50 is already, we saw that little rally off of the 50, kind of the guiding to 50, and then you're going to look for 25. And the market is going to like that as long as the economic data doesn't start falling off a cliff.
Right.
All right. If we start to get to that point where bad news is actually bad news, because remember, right now, bad news has been good news because it means that the Fed is less likely to hike when you get that bad news. It means the economy is slowing, so they're not going to raise rates as much. But if we get into that next period where you see bad news starting to become bad news again, then I actually think that it doesn't matter. The market will realize that the Fed's not going to cut rates, and bad news means we're slipping into a recession with no bailout from the Federal Reserve.
All right. We've currently got about 1,000 people watching us live. Spread the message to your friends. I know this isn't the World Cup, but this information might save your life trading-wise. So please spread the information to your friends and family and your colleagues. Get them to come watch and submit your questions live. Hit that subscribe button. Gareth, let's talk about the CPI data that's coming out next week. CPI is coming out now. 7.7% was the last reading, been coming down steadily since 9.1, which was the peak back in June. Narrative that the Federal Reserve is spinning is that inflation has already peaked, and it will never see 9.1% again. Well, at least not for the foreseeable future. It's not 2%. It's not 9%. Where are we going to go?
So it is coming down. There's no doubt about it, and you will see a number that reflects that. And part of the issue here is that inflation is from the past year. So 12 months ago, how much has inflation gone up? Well, if we go 12 months ago, inflation numbers were already spiking. So what it's telling us is that yes, the inflation numbers are still going up. We're still seeing inflation, but the rate of increase is slowing. And that's what we see in these inflation numbers that are coming back in. And I think that's a common misconception. Everyone hears, oh, the inflation numbers were better than expected when they come in, but it's not saying prices are going down. It's just saying they're not rising quite as quickly. So I think investors have to be ready for that. I mean, it means that the prices at the grocery store are still going to be going up over time, just not as quickly. And it's going to hurt the economy. There's no doubt about it that investors and retail Americans in general are going to feel the crunch in 2023. You have inflation, then the Fed's going to basically push us into a recession that they can't bail us out. And remember, since 2009, the Fed has just been printing us out of every trouble, whether it was, you remember obviously 2009, the collapse in the banking sector, all the bailouts that went on and the quantitative easing that was started. And then that basically continued. And in 2018, we saw them say, okay, we got to start raising rates. The market threw this big hissy fit, dropped 20% in a matter of 6 weeks. They actually reversed and started cutting rates again. And then it takes you into COVID, and we know what happened during the COVID crisis with them printing even more money. And that was the massive printing of money that we saw. Yeah. And so it's really everything. It's the inflation numbers, it's the economy that's going to be slowing, and it's also just the overall kind of wear and tear that it does on the consumer.
Well, on the bright side, now is a good time to use tax loss harvesting.
That's right.
But for those of us who are just more forward-looking, let's talk about the housing market real quickly. Mm-hmm. Pending home sales in the U.S. down 37%, close to 40% in October. Yeah. That's worse than 2008. And I don't see a Lehman-style collapse just yet. People are free to go out and buy homes. We're not in a COVID lockdown. So what's going on?
Yeah, so there's no doubt about it that when you see the 30-year at 7% and home prices are still elevated, very, very elevated, there's not a lot of people that can afford that monthly payment. One of the best indicators of the struggles in the housing market, I got back from Boston 6 weeks ago, and I got into my Uber, and it turned out my Uber driver was a real estate agent, right? Yeah. So that tells you everything you need to know about real estate right now. I don't necessarily see that same sort of 2008 collapse yet, but it is something we have to monitor. And I think you have to expect that if interest rates are going to remain elevated, then home prices probably have 20 to 30% downside from their highs.
That is something that the Dallas Fed has even said. The government, the Dallas Fed, has issued a report recently saying that in a bad scenario, housing prices could depreciate a further 20% from current levels. And importantly, they said this could bring down consumer spending even more. Yeah. Because if you feel like your home is worth less, you feel poor.
Well, it's the wealth effect, right? It's everything to do with 401ks that when the Fed talks the market down, and remember, the Fed has done that, right? They see the market rallying and they'll say, hey, listen, we're going to be more hawkish, and the market sells off. They don't want the stock market to be up to all-time highs because it creates this wealth effect where people say, hey, look at my 401k. It's worth X amount. I can go buy that new car now. And same thing with home prices. Your home, you bought it last year. You already made 100K on it, and it created this wealth effect. So it's all tied into this inflation that's going on. And I do absolutely think that this is one of the things the Fed needed to pop these bubbles. Now, the question is, can the Fed control the collapse? In history, they haven't done a great job of it. I'm doubtful that they can again.
Okay. Well, how does this sustained inflation level that you talked about, how does this translate to the markets? Let's start by talking about the stock markets first. And I do want to just spoil the thesis here because it is important to set it up. You have told me before in prior interviews, and you told me again offline just today, that you don't see the stock markets recovering to its previous all-time highs until several years down the line. We've seen a recent precedent for this, actually. The NASDAQ, following the the dot-com bubble burst in 2001, didn't recover to its previous 2000 level high until 14 years later. Is that going to happen again?
Yeah, I do think it is, and it actually could be worse. So I do think at least a minimum of 10 to 15 years. I want to show you some really cool charts here. So
take a look at the charts.
Here's the Dow Jones Industrial Average, and I'm going to show you guys why I'm showing this chart. So take a look at what we have here. You have this sort of pattern, which is basically this M pattern top in 1915 to looks like right around 1921. All right, and again, you're going to say, well, why the heck is Gareth going back to this period? And then look at the run that the Dow Jones Industrial Average had for the next, basically in the roaring 20s to obviously the Great Depression, the collapse, the crash of 29. And so if you look at that, and now let's just go right to the S&P 500. And this is where it gets crazy, right? So what we can see is that same sort of pattern formation from the dot-com bubble, the dot-com collapse, the real estate bubble, the real estate collapse, and then look at the massive massive run we've had. Now, a lot of people would say, okay, that's just a chart. It's just, it's a coincidence. But what you have to do is you have to delve deeper. And this is where I love being a student of history. And what you do is you look at what was going on in the early 1900s, 1915, 1920s. And what was happening was cars were becoming more and more the norm. Electricity was becoming more and more the norm. Well, what did that give us? It gave the consumer light at night. They could go out at night. They could go to speakeasies, spend money. They could drive more than, before cars, you were limited to the distance you could go if you wanted to go to the general store, right? And so you had all these things coming into play that created a consumer that could get out there and spend money. Then look at what the lending stuff was in the 20s. There was lending policies that are very similar to a lot of the lending stuff that we're seeing. Now, if we go to the current times in the S&P 500, in the dot-com era, what do we know happened? The internet emerged, right? And the internet basically gave, do you shop on Amazon?
I do.
Well, so do I. And think about that. Now you didn't even have to leave your house to shop and spend money. And so there's these coordinated factors that make me think that we're very similar to what happened in the 19 teens to the 20s leading into the into the Great Depression. And I don't want to, it's hard for me not to jump to that conclusion, but I am very concerned that we could see something like that occur.
We're about to jump into the 20s?
Yeah.
The roaring 20s?
Roaring 20s.
Okay, so that should be good for the markets, not bad.
No, because if you look at the chart, if you look at this chart, look at the S&P run.
Yeah.
And then if we flip over to the run from the 20s, we're at the end of the roaring 20s.
Okay, we're running towards the end. We're running out of steam.
The same sort of movement is there.
Well, we're only going to run out of steam if people run out of money. Is that the case?
Well, think about it. Let's say housing prices drop 20, 30%. Let's say your 401ks, let's say the stock market goes down 50%. Now let's take it a step further and say the Federal Reserve will not be coming in to print money, because if inflation, let's say, is at 4 or 5%, how do they print trillions of dollars with the risk of inflation jumping to 20 or 25%? We don't want to be Venezuela. We don't want to be some of these countries where you have this kind of crazy inflation. So the question is, how do we get out of the next recession? And that's the question. I don't have the answer for that. We might just have to pay the piper at this point.